Hey guys, welcome to another episode of Thinking Like a Bank, where we show you how to think like a bank using the same strategies and principles that banks use to help you find more financial freedom in your life. I'm your host, Sari Ibrahim. And some of the core principles that we talk about of thinking like a bank are real estate, investing in real estate, saving on taxes, having safe and predictable income. And I wanted to touch on one of those things today. It's investing in real estate or buying a home even. This tends to be, for a lot of people, a financially lucrative area to be in, either short-term, long-term, or however you want to position your financial goals. Investing in real estate tends to be a good financial place to go to. And one of the ways that a lot of people leverage real estate is through mortgages, either from as homeowners or as real estate investors. Although mortgages being helpful, not everybody could qualify or apply for a mortgage. You have to be approved, and there's some qualification things that you need to go to get approved for a mortgage. And which is why I wanted to have today's show specifically on this subject of how to apply or what to consider when applying for a mortgage. And I have with us today a special guest. His name is Mr. Robert Weinberg. He is the host of the Connecticut Real Estate Edge podcast and Mortgage Matters radio show. He's a mortgage expert and financial coach. Robert, welcome to the show.
Thanks for having me.
Thank you for being on. Before we jump into all of the mortgage thing, the lending criteria stuff, let's talk a little bit about your background, if you don't mind sharing that with us.
Yeah, gosh, where do I start? I mean, I was an entrepreneur from a young age, like 16, 17, just looking at ways to make money and whatnot. And really got into entrepreneurship heavily around probably 18, 19. I got into my first direct sales network marketing opportunity, thrived with that, and made some contacts and did some networking that led me to the mortgage industry. A friend that I had met through the network marketing opportunity ended up opening a mortgage company. This is way back in the 2004 timeline, 2005, maybe even a little before that. And he was opening a mortgage company really in the heyday of real estate, prior to the real estate crash, and was looking for good people. And we had a good relationship, both on a personal and business level. So I was just starting college at that time, and he was telling me I could work from my dorm room basically and help him with mortgages, taking loan applications, that sort of thing, and learning the business while I was in college. So I did that for a couple months, did really well. He flew me out to his headquarters in Chicago, really trained me on how to originate a mortgage, some of the guidelines, and how to get a loan through the system. And, the rest is history. I ended up opening my own mortgage branch up a couple of years later in 2006 with Benchmark Mortgage, same company I'm with now. I'm now licensed in 3 states, Connecticut, Massachusetts, and Florida. But the information we'll be talking about is applicable no matter where anyone may be in the country. There's no geographic limitation. But those are the states I can personally work in and where I'm licensed. Again, Connecticut, Massachusetts, and Florida. So, had a very good run. And of course, the last year or so has been amazing with these record low interest rates, property values going up, all that sort of thing. And, I'm just at this point very blessed to be in the industry. It's been a record year for almost everyone. And now I'm able to share my knowledge on podcasts, on radio shows. I have my own YouTube channel, and just really spreading that knowledge out to people all over, whether I can help them or not. I just want to give that knowledge because it's really a lot of information that's not talked about in school. You're not going to learn it really from a book. You only learn it from experience and with dealing with people that have that experience of thousands of loans. I've done now over 1,500 mortgages in my career, and everyone is different. Everyone has challenges, and you learn a lot over the years with all that experience. So hopefully we can share some things to help people on their journey today.
Yeah, thank you so much for sharing all of that. And I've kind of seen a lot of kind of the basic things of when applying for a mortgage. One of the first things I think that the light bulb that goes off is, credit score. Like, what kind of credit score do I need when applying for a mortgage?
Okay, yeah, let's talk about that. I mean, I will preface the answer to say that a lot has changed over the last 12 months due to COVID. Mm-hmm. So before the pandemic set on, you could really get a mortgage, a pretty good mortgage with a 580 minimum credit score. This is not necessarily the credit score you're going to get from Credit Karma or online, but it's a mortgage credit score. And the mortgage company, every mortgage company in the country basically uses the same scoring model. And they're going to pull a 3 bureau report from TransUnion, Equifax, and Experian, and they're going to go off the median score, which is the middle of the three scores. So before the pandemic, like I said, you could squeeze in with a 580. Now, I mean, it tightened up a lot mid last year, and now they've relaxed it a little bit. So here in early 2021, we're looking at probably a 620 to 640 as your kind of minimum barrier to entry. If you have a 580, but you have a big down payment, really good income, and just a lot of compensating factors, you might be able to find a mortgage loan officer in a mortgage company that will entertain getting your loan done down into that, high 500s. But on an average basis right now, you really want to have at least that 620 to 640 minimum to be able to get a decent term on a mortgage right now.
So what if I'm at, like, for example, 580 and I want to get it up to like 640 in the next 2 months? Is that possible?
For some people it is possible, for some it's not. I always tell my clients, it's like, it took you years to get into debt, so it might take a little longer than a month or two to get out of it. And what I find is with most people with those lower scores in the 400s, 500s, there's a reason for that. It typically is they're maxed out on their credit cards, they don't make payments on their bills, they have a lot of collections. Those are probably the three main reasons. So, if it's simply your credit cards are maxed out and that's why your score is low, that can be fixed within 60 days. You can just go make big payments down on your credit cards. You want to get them to, ideally 10% of the limit. So if you have a $10,000 limit, you want to get it down to $1,000 or less. If you can't meet that, because that's a very tough act to really get, 30% would be the next threshold. So on a $10,000 credit card limit, you want to have $3,000 or less. If you can pay your credit cards down to 30% or less of the limit, wait a couple weeks for it to report on your credit, you could see your credit score go up 50 to 100 points in a very short period of time, possibly a couple months. But most people that have the scores that low, it's not just because of, credit cards that are maxed out. Typically there's collections on there, which they could do what's called a pay for deletion. We don't have time to go into all the details, but a pay for deletion would delete those collections off your credit report if you agree to pay them. That could quickly boost your credit score. But if you have late payments and they're legitimate late payments, you just didn't pay your bills, it's going to take longer than a couple months to get your credit up. Typically, you're talking about 3 to 6 months minimum to recover from that. And that would entail building new credit, because when you have old stuff, there's only really one way to offset that, which is to get new credit that's positive. And the issue is nobody wants to give you credit when you have bad credit. So I've come across a couple companies you can find on my YouTube channel, like Credit Builder Card and some other, Self Lender is another one, that do unsecured or secured different types of loans and credit lines that have no credit check. So you can go in there with a couple $100 and get positive trade lines on your credit to help offset the negative. And I found by doing that, even if you don't do anything with the old stuff and we just add a couple good new things on there, you can see an increase of 30 to 50 points within just a 60, 90-day timeline. So those are some things that people can do quickly, but I wouldn't, in most cases, suggest that 60 days is enough time to have your credit go up from a 580 to a 620 or 640. Every circumstance is different, which is why you need a good mortgage advisor or a coach financially to say, here's exactly what you need to do, here's the game plan, and here's the timeline that it's going to take.
Yeah, I like that. Definitely. I think credit, aside from mortgages, it's its own subject, and it requires, an expert, a coach, somebody to kind of walk you through it. Again, like you mentioned, this is not something we're taught in school. I think we should be taught this we should be taught about this in school, but we're not. Now, as far as you've mentioned this on your other shows, on your other YouTube channels, that there is a difference when applying for a personally owned property, like a home you're going to live in, versus an investment property. Can you explain some of the differences, please?
Yeah, I mean, I'd say there's two main differences. Number one is that a personally lived in property, or what's called a primary residence, is going to require lower credit score requirements, which is good. You don't need as good credit. It's going to have more expanded debt to income limits, so you can, have a lower income and qualify for more of a mortgage when you're going to live there on a lot of loan programs. And the down payment, when you're buying a property to live in, There's low down payment options as little as 3% to 3.5% in many cases. If we flip over to the investment side, you're talking about typically 15 to 20% down minimum on a multifamily, possibly even 25% down. So a much bigger barrier to entry there. You know, you're not going to get an investment property loan on a conventional mortgage with a 580 credit score. It's not possible. Absolute bare minimum would be 620 again, but it's like on an investment property, you're going to have a really big down payment to offset that lower credit. That's where having the excellent, good to excellent credit, high 600s, low 700s, you're really going to want that to get decent terms on an investment property loan. So for most people, they're going to start out with a primary residence, whether that be a single family home or a multifamily home, because there are loan programs where you can live in one unit and buy like a 3 or 4 unit, rent out the others, live there for a year, and then use it as an investment property later. So it kind of gives you the ability to kill 2 birds with 1 stone, become a real estate investor and have a place to live at the same time. And those loans, certain programs only require, again, a 3.5% down with the particular loan I'm thinking of, up to 4 units. The caveat is you have to live in units for at least 12 months. That's the key. So that's a big thing that, you know, if I were to do it all over again, that's what I would do. I would go and buy a 3 or 4 family house using an FHA loan, live in one unit for a year, rent out the other units, and then after a year, go buy my single family home or another property. Now I have a rental property that I was able to get with a low down payment. You can have your tenants paying your mortgage for you at that point. It's one of the most underutilized strategies, but it's like, you know, I see all over TikTok, YouTube, Facebook. A lot of people are saying, gosh, this is so great. Like nobody knows about it. So we're here today to bring this to you, because if you're watching this and you haven't used your FHA eligibility yet, or you haven't bought a property, this might be something that really rings a bell for you. And if you want to be a real estate investor, this is how you can do it right away with very little money down and a great loan. I mean, these FHA loans are phenomenal, very low interest rates. They're government backed, and it's the only loan program. Well, I shouldn't say that. It's one of the only loan programs that allows you, especially with these lower credit scores we're talking about, to get in a multifamily and really build that real estate investment from the get-go while still, you know, having that primary home.
Wow, that's awesome. We should have just named the whole podcast, this whole episode, just about that. That's awesome. Now, I know, look, for example, let's say I was going to buy a property for, you know, $300,000. There's some closing fees, right? There's some closing fees. It's not just $300,
Yeah,
$300,000.
that's probably one of the biggest myths or misconceptions, especially first-time buyers have. I mean, anybody that's bought a home that's listening right now knows there's closing costs when you buy a home. They're huge. I mean, they're big amounts of money, thousands, sometimes tens of thousands of dollars. But a novice that's never done this before, they look online or read something and see, oh, I only need 3.5% down, 5% down. And they think, oh, I've got 10 grand in the bank, I can buy a house, but they neglect to understand that there's closing costs. Now, I know you have a diverse audience all over the country, so it's hard to give an exact number, but I would suspect majority of the United States, in addition to your down payment, you'd want to have anywhere from another 3 to 5%. If you're in a higher cost area, closer to 5% additional funds for closing. If you're in a lower cost area, you might be able to get away with, you know, another 3 to 4%. And again, that's on top of the down payment. Now, in previous real estate markets, it was possible to negotiate to have the seller pay some or all of those costs. And the loan that we were just talking about, the FHA loan, allows the seller to pay up to 6% towards your closing, which can cover all of the closing costs and then some. But in this market we're in right now, in early 2021, all over the country, we're hitting new highs in values. It's very competitive. It's a seller's market. So if you go in, or your real estate agent goes in and requires that, you know, my client only has 3.5%, you have to pay the closing costs, you're not going to get a deal. Like, it's very rare, because that's money out of the seller's pocket. When you're in a buyer's market and things cycle and change, like it was a year, 2, 3 years ago, you can negotiate to have the seller pay some or all your closing costs. Right now, today, it's very rare, and it would require an expert realtor on your team to negotiate that for you as part of the process, as part of the negotiation. So make sure that you have at least, like I said, another 3 to 5% on top of the down payment minimum to go towards closing. That's going to give you the maximum flexibility, because you're better off having the money and not needing it
Mm-hmm.
than you are to say, I found my dream home, but now I only have 5,000 available, or I have 3,000, or whatever it is. And now you're not going to get that deal because you don't have enough money to pay for the closing costs on your own.
Okay. And what are some, so for example, let's say the closing costs are $10,000. Do you have to pay that upfront with the down payment, or could you add that to the loan balance on the mortgage?
Pretty much in all cases, you do need to pay that up front. There are a few strategies that I teach my clients, like using premium pricing, where the mortgage company can pay some of those closing costs for you. So basically you take a higher interest rate, and in exchange for you taking a market or higher than market rate, the lender, the mortgage company, will pay a portion of those closing costs. With rates being so good right now, there's not a lot of premium in the pricing for that. So it's very rare to have the mortgage company pay all the closing costs right now. Can we get you a credit for, $1,000 to $5,000 out of the closing costs? Yes, you'll just want to talk to your lender about them pricing your loan with premium pricing, which means that, again, you're paying a higher than market rate. So maybe you qualify for a mortgage at 3%, but you don't have all the money for closing costs. So they give you a rate at 3.5%. So it's a half a point higher, but in exchange for you taking that higher rate, the mortgage company can do a rebate back to you at the closing, or what's called a lender credit. So that could, that changes all the time based on the market. It's constantly changing. For you taking that higher interest rate by a half a point, that might give you a lender credit or a lender rebate back of, again, anywhere from 1,000 to 5,000, maybe even more, depending on the price of the property. So that's one way, that you can creatively do that. Otherwise, when you're buying a home, in pretty much all cases, you cannot roll in closing costs. You have to pay those up front. When you're refinancing, we can roll in closing costs in almost all cases. But when you're purchasing a home, it's just not allowed.
Okay. And what are some acceptable forms of down payments? Like acceptable funds and uses?
So, the most common down payment uses, or I should say sources, are obviously the checking and savings accounts. Like, that's the best way to get money towards buying a home, is to have it saved up in a checking or savings account. The next place would be a retirement fund, like a 401k, IRA. Most retirement plans have clauses that allow you to borrow money against them to put towards your first home, and or withdraw money. I typically recommend that you borrow it and not withdraw it, because it's acceptable to mortgage companies for you to borrow it. And if you withdraw it, it's gone. Whereas when you borrow it, there's certain advantages to borrowing it. It's a good interest rate and whatnot. So that's another good place, is retirement. And then the next place would be gifts from family members. So you can get money from a family member, a blood relative, aunt, uncle, brother, sister, parents, grandparents. Very common to get money for your first home from that. You'll want to talk with your lender. Everyone has different ways of verifying. There's some documentation they'll need to get, gift letters that need to be signed, and things as part of the process. So don't just go to your mom and say, hey, I need $10,000 to buy a house. Talk to your lender, communicate, get the criteria and the protocol that they're going to use and their underwriter is going to use, so you can make sure to get the right documents. Again, gift letter, bank statements, there's certain, criteria and process that needs to go through. And one that I will mention here that I don't mention when I talk about this normally, but I know you have a sophisticated financial audience, is, cash value life insurance. Huge, amazing place. Probably of any of these I've listed, probably the best place. If you're listening to this and you've got cash value life insurance, whole life, universal life, any type of cash value life insurance policy, that's going to be an amazing place that you can borrow money. Absolutely acceptable to any mortgage company, any mortgage underwriter. And, there's a lot of advantages, like you've talked about in a lot of your other lessons and videos about using that. So most of the people I talk to that are first-time buyers, they don't have the cash value life insurance piece, but I know a lot of your audience may. So that can be just an amazing place to be saving towards your down payment. And then you can borrow a large percentage of that cash value to put down and still have it working for you using, as you know, the bank on yourself and other insurance financial strategies. So those would be my top 4 areas to get your down payment and closing.
Yeah, thank you for sharing the piece about the whole life insurance. Yeah, that's right. So if you had, for example, $50,000 in a whole life policy, you could borrow against that, use it as a down payment, and then kind of pay it back. And a lot of people are kind of curious, like the lender doesn't view that as borrowed money. They don't, right? It's your,
No.
yeah.
There's no payments required, as you know, on
Okay.
those type of loans. There's actually an actual column on the loan application for cash value life insurance. Like
Okay.
it's that common, for people to use, that there's a separate line item for that. So it's not only is it not looked at negatively, it's probably one of the easiest, best, and safest places to get that down payment money. You're not tapping your stocks, 401ks, investments. You're not liquidating money out of your checking or savings that you may need for a rainy day. So it can really make your loan application look very strong. If you have money in checking and savings and retirement, you're not using that though. That money's going to stay there. We're going to borrow money against the life insurance cash values to fund the down payment. Just makes you look financially strong to an underwriter. They don't want to see you tapping every dime.
Okay.
They'll let you, but it doesn't make you look very good. But if you've got 5 to 10 grand in the bank and then you're tapping cash value life insurance, now that money in the bank stays there. Now that's reserves. Now that strengthens your loan application. It might even allow you to get approved for a higher mortgage.
Oh, wow. That's awesome. Thank you so much for sharing that. Now, as far as like, let's say, for example, today is, we're in the middle of February 2021. Let's say I wanted to buy a property in August of this year. When should I start speaking to a lender?
I mean, the answer is as soon as possible. I've had clients come to me several years even ahead of time. I would say the more uncertain you are about your criteria for a mortgage, meaning your credit, your income, your assets, the more unsure you are about that, the earlier you should meet with a lender. Do not worry about going to a lender 6 months, a year ahead of time. You're better off being early and doing it soon than you are doing it too late. Because I do have people contact me that say, hey, I just went under contract on a house, or I'm about to put an offer in and I need to get an approval for a mortgage. Really, that's too late. We can't work on your credit at that point. I can't give you strategies for down payment and the stuff we're talking about. That doesn't give us enough time. If you meet with your lender 6 months, a year, or even a couple years ahead, we can map out an entire roadmap for you to say, hey, you need to put another 3 to 5 grand away in this account. You need to pay this credit card down. You need to pay off this loan. I can give you that roadmap if we have time. If we don't, you're screwed. I mean, that's the bottom line. You get what you get. We don't have time to mess around and strategize. It's just going to be whatever your credit is, whatever your debt is, we put it out on the plate, and it is what it is. Those are the terms that you get. So I would say bare minimum would be 60 days before you're ready to start putting in offers. That's the absolute minimum. That'll give us time to verify your documents, income, assets, credit, make some recommendations, or ideally say to you, you're in a great spot. Go out and start looking at houses, give you that pre-approval letter. But if you do need a little bit of guidance, or like I said, pay down this debt or that, if you have at least 60 days, we can make some minor adjustments. Anything less than that, again, you're just, we have to play the hand that we're dealt at that point. So ideally several years, but at minimum 60 days.
And then once you do get that pre-approval letter, how long is it good for?
Every mortgage company has their own criteria. I would say average is probably 90 days. My company, we have our pre-approvals good for 120 days. So basically 4 months from the time that we run your credit until it expires. The way the normal timeline goes is if you've met with us ahead of time and you're ready to go and we've done what we're talking about here, we would run your credit, get all your documents, issue the pre-approval within just a few days of getting that credit report. And then you can start going out shopping for a home immediately. The market is competitive, but I would say in most cases, you're going to end up negotiating on a few properties, putting in offers on a few properties, and ideally you're going to have an offer accepted within the first 30 to 60 days of that pre-approval. That then gives us another 30 to 60 days after the offer is accepted to process your mortgage application, because a mortgage it's not an overnight thing, regardless of what a billboard or an online advertisement may tell you that you can just push a button and get a mortgage. That's just a marketing gimmick. There's a lot of moving parts. For 99% of America, it's going to take more than pressing a button. There's going to be a lot of documentation required. There's going to be a lot of questions asked. There's going to be a lot of coordination and communication to be done, and you want to leave at least 30 to 60 days after you go under contract to get all that done. Now, if the pre-approval expires, it's not a big deal. We can just update it, rerun your credit. But of course, anytime you update credit or change things, you don't know. The score may drop, new debt may show up. Like, there are potential pitfalls that can come up. So most of the time we would try to have your loan fully approved and closed within that 120-day time frame. But again, check with your loan officer, because some mortgage companies, it may only be good for 90 days.
Okay. And what if it's approved at like $300,000 and you find a home that's $320,000? Do you have to like get a new approval for that extra $20,000?
Yeah, so typically your mortgage loan officer is going to look at what your maximum price point is going to be and or what your maximum payment's going to be. You know, you could have two houses next to each other that are $300,000. One of them, the taxes are $5,000 a year. The other, the taxes are $8,000 a year. So it's really important that you coordinate with your loan officer to find out from them, like, what's my maximum payment, and have them run numbers. But usually we're going to figure out what your maximum is going to be, and then kind of go down from there. So if it's over your maximum, like you're saying, if you're pre-approved for 300 and you find something for 320, the easy answer is you make up the difference. You come up with the extra money that you need to, you know, in this case, $20,000 to make up the difference. Possibly if the taxes are lower, or there's other, you know, criteria that are met for the property, maybe we could squeeze out, instead of 300, maybe we can get you to 305, 310. Maybe if the taxes are really low, we could get you to that 320. Because when we're doing the pre-approval, we're going off an estimate, you know, of what properties in that price range are going to be. But I've had some people come back where the taxes are way higher, or the taxes are way lower, and that's going to affect the total amount that you can borrow. So the real number that you want to get here, and the takeaway from this question, is going to be find out your maximum payment, not what your maximum amount of money is going to be that you can borrow, but what's the total payment. And that includes mortgage principal, interest, property taxes, home insurance, HOA fee. If there's an HOA, you know, condo, townhome, you want to factor that in. And then any PMI or mortgage insurance. When you're putting a low down payment or getting an FHA loan, it's going to have a mortgage insurance or PMI, which is required. So you're going to want to have all that factored in. Your mortgage loan officer will guide you through that process and what that payment's going to be, but it's going to be an all-inclusive payment. And I usually have my clients send me the property, or have their realtor send me the address and what the taxes are and all the specifics. So before they put in an offer, I can say to them, here's your max price on that house. Period. That's it. You cannot go above that price unless you put more money down. And that's how we do it.
Okay. And then let's say, for example, all those things, the taxes, the principal and interest, the homeowners association, if there is one, you sum the total of it, and let's say it comes out to $2,000. From a lender's perspective, what are you looking at for monthly income? Is it like 2 times that, 3 times that?
It really depends on the debt. So a mortgage company is going to look at two ratios. They're going to look at a front end ratio and a back end ratio. The front end ratio is what you're talking about. That's what is the mortgage in a percentage of your income. Okay. So if you make $5,000 a month and the mortgage payment's $2,500, that's 50%, right? But that's the thing, that's not the only ratio they look at, that's just one. Really, almost the more important ratio is what we call a back-end ratio, or total debt ratio. That's gonna not only include the mortgage principal, interest, tax, insurance, PMI, HOA, that's also gonna include all of your debt, car leases, medical bills, installment loans, personal loans, credit card debt, student loans. Any and everything that's showing on your credit as a debt is going to be included in that total debt ratio or back-end debt ratio. FHA loans will typically be the most flexible. They'll allow up to a 56.99% back-end ratio, which is unbelievable. It's incredible. A VA loan actually will allow a higher debt ratio, but most people are not veterans, so most people won't be able to get a VA loan. So let's talk to the majority here about FHA and conventional, because that's going to be typically what they're going to be looking at. So again, FHA will allow you up to a 46% front end ratio, so the mortgage versus your income, 56.99 back end ratio, which is everything, the new mortgage and all of your debt, and that's the percentage. Your loan officer will calculate that for you. On a conventional mortgage, you're typically going to be capped at around, the front and back has to be between 45 if you have lower credit,
Mm-hmm.
and I've even seen up to a 50%, or let's say 49.99% on the total debt ratio on a conventional loan. But that's only going to be in cases where you have excellent credit
Mm-hmm.
and you have, money in reserves and all these other things we're talking about. That's where you can push it to a 49.99% type of debt ratio. And that's going to be, again, for your people that maybe have the excellent credit, they're putting more money down or whatever it may be to mitigate that higher debt ratio. Most of the time, they're going to want it to be 45% or less, both front and back end ratio on a conventional loan.
Okay, that makes a lot of sense. Now, what does the whole process take, like from step one, somebody contacting you, all the way to moving into their home? How does that process look?
It can be very quick.
Mm-hmm.
It really ranges. So communication is key. If you've got your act together as a home buyer and you contact me, I had a client call me and they were ready to go. They were already under contract. They had actually been pre-approved by another mortgage company who dropped the ball on some things. So by the time they called me, they were under contract, ready to go. And we were able to get that closed in about 3 weeks, which is phenomenal, start to finish.
Mm-hmm.
Now, in a normal circumstance where there's negotiating and there's, the back and forth, the appraisals, the title searches and all that, I would say realistically, probably 30 to 60 days is going to be the timeline on that. It's going to come down to the seller of the house that you're buying. How quickly can they move out and let you in there if they're living there? Also, the other people involved in the process. Appraisers are very backed up right now. They're in big shortage. An appraisal can take 2 to 4 weeks, just that one part, depending on where you're at in the country. Title searches, again, depending where you are, can be anywhere from a couple days to a couple weeks. So all these are going to be variables that are going to change based on where you're at. But I would say average is going to be between 30 and 60 days from start to finish. And that's what your realtor is going to negotiate as part of the contract to say, here's when we need the mortgage commitment by, here's when we need the loan ready by, and then here's when the closing date will be. And those are going to be the guidelines and the dates that we go off, which are going to be in the contract that you sign to buy the home.
Okay. Okay, perfect. Yeah, that makes a lot of sense. And I really appreciate all the information you've shared. You've helped us a lot. You've identified a lot of points. And I love your perspective on all this, from like the intel of a bank, kind of your perspective on what the bank is looking for. Now, aside from all the lending stuff, I want to get to know you a little bit better. What are some things you do to manage your time?
Well, I mean, I'm using, a lot of things. I've got calendars all over the place, task lists. So I'm using, my Outlook calendar. I'm using my Google Calendar on my phone. I've got multiple apps, on all my computers that are alerting me of different things going on, podcasts I need to get on, different meetings I have. I use a CRM, contact management or customer management system that keeps me on top of all my follow-ups with my clients. All my reviews I need to do with clients, different tasks that need to be done during the loan process. And then I'm just a big user of checklists. So a mortgage is not rocket science. It's like the same thing every time as far as the milestones that have to get hit. So, I'll just take like a folder and I'll just write on the folder, all the things that need to get done. I'm just going to see if I can find one. So like, here's a folder right now. You can see I've got a checklist here of 2 things I have to get done. So I'll just write that right on. And then I've got in the bottom part of here, a couple items. So I'm just a big user of checklists because I'm processing anywhere from 20 to 30 mortgages a month.
Oh, wow.
And it's a lot of details to manage, obviously. I also have a loan officer that works under me, and she's processing 8 to 10 of her own loans as well. Wow. And I'm helping to manage that process. So there's a lot of details and there's a lot of things that could get missed. And the reason we have such a good reputation and such a great rating online and been doing this so long is because the details are where the really the success is going to be. If you leave out or miss any detail, you can completely derail a real estate transaction. So we use these checklists on every file all the time, and we're making sure that every single thing is done that needs to get done. So when an underwriter looks at our stuff, they're like, okay, we've got everything here and they can just get it done. That's why we have a good reputation with our underwriters because they know there's not going to be questions and concerns. We're going to handle all the details, dot the I's and cross the T's. And that's, again, just using good checklists, task lists, things of that nature to keep us on top of it so nothing gets missed.
Yeah, you mentioned something really cool right now because insurance is kind of the same way too. So the underwriters tend to kind of, as you're building more policies and building more deals, in your case, they tend to kind of underwrite you and know that the cases you're bringing them are going to be pretty good.
Mhm.
So therefore, you're almost like an underwriter yourself, and that helps you in your business. And that's kind of an advantage that you can pass on to your clients, is that you know what the underwriters are looking for, and they're going to trust you and trust your paperwork because you've been doing so much business with them.
Absolutely. I mean, it doesn't matter what business you're in. Every business has a process. Every business has a strategy. Once you've done it enough times, you need to come up with your own checklist, task list, that sort of thing, so the details don't get missed. And I mean, that's really a key to success, no doubt. I would say those, using a calendar and being methodical about a calendar, number one. Number two, a CRM to stay in touch with your clients. I have details in my CRM. I've been using the same CRM since 2007. So I've got literally notes in there that are 10 to 15 or 13 years old. And I can see those notes just by clicking a button and see where I started with a client all the way to where they are now. I have a lot of clients I've done business with 4, 5, 6 times, different mortgages that they've needed over the years. And all that's stored in the contact management system, keeps me abreast of different follow-ups that have to get done. And then lastly is, like we said, the different checklists. Whatever works for you as a business owner, as an entrepreneur, as a salesperson, whatever you're doing, you need to find what works for you. Everybody's different. This is what's worked for me, and will continue to. I'm not changing it. I still have, paper file, not a big paper file, but for most of my clients, I have at least 1 or 2 sheets of paper that have different loan conditions or different checklists to stay with. I like having that physical piece of paper in my hand. I have a file cabinet here filled with all that, because sometimes you just need to be able to scribble something or cross something out. There's something about that just makes it more tangible and makes it a little more efficient. I know some people are religiously just using stuff online and online tools, but again, doing this now for about 18 years, I'm still using some of the same tools that were successful for me when I started, and they're still successful today. So if it ain't broke, don't fix it.
Right. I agree. Yeah. I actually use checklists myself, paper checklists for my calendar. And even though I wouldn't say tech savvy, I use software on a daily basis, I still have to write things down on paper every day. I just can't just do everything 100% digital. Yeah.
Exactly. Again, everyone's got their own thing that works for them. So you need to find something and stick with it. Consistency is key.
Right. Yeah. I appreciate everything you mentioned today. You brought us a lot of expert advice on today's show. How can listeners get in contact with you?
Easiest way to get in touch with me is going to be directly through my website, which is robgw.com. So it's www.robgw.com. You can contact me through there. If you're in Connecticut, Massachusetts, and Florida, and you'd like my assistance, you can apply right on my website securely for a mortgage, whether it be refinancing or a pre-approval for a new property. You can also contact me on there as far as email, and there's a contact us page. And then if you want to reach me directly by phone, your best bet is just to call my office. My direct line is 860-413-3938. Again, 860-413-3938.
Thank you so much, Robert. Thank you so much for being on the show.
Thank you for having me. Talk to you soon.
Thanks. To learn more about what we do and how we can help you grow more wealth, please visit www.finassetprotection.com. That's FIN, assetprotection.com. The topics presented in this podcast are for general information only and not for the purposes of providing legal, accounting, or investment advice. On such matters, please consult a professional who knows your specific situation.